Talk through in detail. That's great. Okay, well, look, we're going to start the session now formally, and welcome everyone to the final day of a 4-day virtual financial summit for US expats. As I was saying earlier, we're looking at many of the concerns of overseas Americans, and if you have been with us through the summit, thank you so much. If you're new as well, then welcome. What we're doing is gathering together some of the top experts in their fields on all sorts of aspects of living abroad. We've already covered taxes in various ways, wealth management, insurance, which is different for people living overseas, of course, cost-effective money transfer, digital nomad life, and voting from abroad. I mean, voting is important too. It affects how you're taxed and how your finances work. So if you have missed any, don't worry, they've been recorded, and today's 3 sessions will be recorded as well, and we will email people with the whole list so that you can choose the ones that you may have missed already. I'm Michael Berland, editor of The American, the magazine for overseas Americans. We're based in the UK, but we are read throughout the world, so we'd love to see you on our website as well. We'll just give you that. It's www.theamerican.co.uk. There's a free newsletter, and some of the articles and features appear on the website too, so we'd love to see you there too. Now, today we are looking at investment opportunities for expats living abroad. We're also going to later on look at American citizens abroad, what they're doing, and cryptocurrency. So it's a good afternoon for interesting subjects. Session 1 today is entitled Themes for Americans Investing Abroad in 2022. And we're lucky enough to have as our expert speaker Brian Dunhill, the founder and CEO of Dunhill Financial. Now, Brian, if I got this right, you're Belgian-born, American-British businessman, and you live in London, so you're perfectly our target audience.
It's kind of like Michael, I don't know if you remember back in the day, they used to have those hair club for men commercials where the president came on and said, I'm not just the client, I'm not just the president, I'm also a client, you know. So I'm in that same situation.
That's it. So but you're in London right now. That's where you are. I'm in England, but I see we're getting people coming in from all over the world, actually, as Panama, from China, Ohio. So yeah, welcome everyone. Brian, I'm going to hand it over to you now. Dunhill Financial, your company, you facilitate personalized investment plans for Americans abroad. I think you specialize in younger expats with long-term aspirations. Is that right?
We have 2 sides of the business in that regards. We have our financial planning side, which concentrates on complex issues, and then we have our Robo Advisor at DF Direct, which I'll be. And
you'll be talking on those issues. That's great. And you'll be looking at an overview of investment themes and opportunities for expats. As I said, the talk will be followed by a Q&A session where I'll be bringing the questions together, so please drop them into the Q&A panel. We've got some coming in already, so thank you. And Brian, over to you.
Brilliant. Thanks so much, Michael. Thank you for the wonderful magazine. We were just talking before we started that this is how we learned all our news about American football and the Super Bowl that's coming up, which we'll be very excited to see this weekend. Today, basically, we want to cover a few overline topics, but the main thing that I want to make sure that you get from this session is the things not to do as a US expat, so that you don't have to dig yourself out of some of those problems. Also, how can you start a plan? How can you start building those types of plans when you're abroad? And then also a little bit with SRI and how we view those types of issues. We'll start with a little informative video.
John Burrow once said, "A man can fail many times, but he isn't a failure until he begins to blame somebody else." Despite these wise words, we are in the age of Trump and Brexit. Therefore, let's start to point fingers.
Most all American expats have had many negative ramifications from the Foreign Account Tax Compliancy Act, also known as Fatca. In fact, it might have led to the closing of your brokerage account in the United States, or even your non-US bank telling you to go elsewhere.
So it's Obama's fault? right?
Not exactly. When you follow along with Fatca brought about, it's really introduced ways that American expats could get caught while not declaring taxes, owning PFICs, or even not declaring taxes that were owed.
So if Obama just built a means to catch non-compliant individuals, why did everything change for expats in 2010?
Well, rules from past presidents started to be enforced. Ronald Reagan, the beloved president that was in favor of cutting taxes, added a huge tax to American expats with foreign investments with the introduction of PFIC rules, also known as passive foreign investment companies. These were designed to prevent Americans from owning managed vehicles from foreign jurisdictions.
So what about the notorious Nixon?
In 1970, Richard Nixon signed into place the Bank Secrecy Act, and American expats had to report all foreign bank accounts that aggregate to over $10,000 US. They have subsequently never increased this amount to meet inflation growth. If you haven't provided these documents, they can lead towards large fines. All the while, no tax is ever owed on these declarations to the Treasury Department. Until Fatca, Nixon and all subsequent presidents had no means to police the foreign banks and to enforce the rules.
For the sake of pinning the blame for the frustrations behind being an American expat, we blame Abraham Lincoln.
Lincoln may have abolished slavery in the United States, but made any American that moved out of the country de facto slaves, of which no other country other than Eritrea follows the logic, and even Canada has banned them from being able to do so. Abraham Lincoln introduced citizens-based taxation with the first income tax signed on August 5, 1861, and was a measly 3% of income to help fund the North in the Civil War efforts. All of the above culminated in what is now known as the Fatca Accords established by Barack Obama. This law was designed to increase the compliance of U.S. taxpayers that had reporting requirements for financial accounts that were held in foreign jurisdictions. To ensure compliance throughout the chain, the new framework imposed legislation onto both the individual and the financial institutions that service the U.S. persons. This led to the stricter reporting standards and larger penalties being imposed for non-compliance. With the newfound power in place, the Fatca Accords essentially became the international policing force for U.S. persons with foreign accounts and assets. With over 113 countries having signed up to comply with the U.S. Fatca rules, and an additional 200,000 plus institutions having registered with the IRS.
So now we know all the acronyms and all the things that can really affect us as an American expat. Fatca has probably led to problems at different banks, whether it be back stateside or in your resident country. And this is to where we need to really reflect about how this is going to work and how we should be placing things instead of just pointing our fingers and stating that it's all problematic. Our firm is one of many firms that helps American expats deal with these types of things to make sure that you don't have problems with them. Now, the last one on that list are PFICs. PFICs are passive foreign investment companies. And these are things that I would avoid in any type of situation if I can. Now, essentially any investment that, whether it's an exchange traded fund or a mutual fund that is put together outside of the United States will become a PFIC. But where you don't have to worry is when they're inside of a pension. Some of the pensions are absolutely no issues. Others can be complicated when it comes to investments. Here in the UK, for instance, a SIP is no problem as an American expat. Other jurisdictions, you might end up with big taxable bills on the US side, so you'll want to talk to your tax accountant before you compound and build up too much of them. The PFIC issues are really outside of those pensions. If you're going out and buying, say in France, an assurance vie, or if you're just building an investment scheme here in the UK, if you end up investing inside of these UK, European, or foreign units, those will compound and become a large taxable problem when you actually take the money out. So we advise not utilizing those functions. We advise keeping the assets in the States. Basically, we want to use either a brokerage that's allowing us to buy US investments inside of them, or actually have the money with a US institution. Now, when should you use each? We have platforms on both. We use Premium, which is part of the Morningstar group here in the UK for ISAs, GIAs, and SIPs. And then we use platforms like TradePMR, Interactive Brokers, and Fidelity in the United States. Just as everything in life, investing in the United States is generally a little bit cheaper than if we use a British or a European platform. But that being said, for the most part, you're investing in US dollars. So the statements are coming in US dollars and the likes. We have several reasons why we want to keep the banking accounts, or I'm sorry, the investment accounts in the United States. Or using US vehicles. The first one is it avoids those PFICs, those passive forward investment companies, and therefore you're not going to get this surprise tax from the US government at the end. The second reason is because you'll get your 1099, making your US taxes much easier. The third reason is the FBAR. The FBAR is a requirement that since the 1970s, us expats have had to report any account that's outside of the United States that has $10,000 or more. They've never indexed it to inflation, so therefore it ends up being a quite onerous reporting requirement. Doesn't cost us anything in taxes, but we just have to report it. If our accounts are in the United States, we don't have to make that FBAR reporting, therefore making your taxes that bit more simple. The fourth reason is safety. In the United States, there is a history since the Great Depression of failure. Joseph Kennedy, John F. Kennedy's father, set up the SEC, which led to SIPC insurance, FDIC insurance, and essentially ring-fenced all of our brokerage accounts for safety reasons, just in case the brokerages disappeared. Best example of this, Lehman Brothers and Bear Stearns both failed during the financial crisis. Bear Stearns was taken over by JP Morgan. All of those clients retain their accounts over at JP Morgan. Lehman Brothers, Barclays Wealth Management went ahead and took over those wealth management clients. So we know what would happen if a brokerage firm were to fail in the United States. That's not always the case in foreign jurisdictions, especially some of the different unregulated markets or minimally regulated markets. The fifth reason we already covered. In the United States, the fees are a lot cheaper than they would be in foreign jurisdictions. But if you decide you want to work with an international carrier that has US investments, the good news is by buying US investments, they're typically a lot cheaper than European collectives or UK collectives. So that is, to me, that big reason why having our investment accounts back in the United States is worthwhile. Well, because it's cheaper and we can accomplish our long-term investment goals. But it brings about a challenge. Like I said, if we have our investment accounts back in the United States, they're in dollars. And if you're living here in the UK, for instance, the UK is just a great example because we've seen this kind of whipsaw action where we had a long period of growth of the pound. Then once Brexit came along, all of a sudden the pound crashed. Now, the last month or so, we've had some recovery and we've had a lot of movements on that. So therefore, if you want to take advantage of potentially lower pound rates, well, you might need to use different means when we're thinking about 10, 20 years out. Now, if you're just needing that cash to get over in the UK to make a house purchase or something in the meantime, you could use future contract, forward contracts, options, and swaps. These are all options, but you can't use those for retirement accounts that would need to last you 30 or 40 years. You'd just be making your broker rich instead of actually protecting yourself. So that's where we would suggest using natural hedges inside of your portfolio. Now, essentially, currencies go on long-term swings. I'm here using the Big Mac Index. We've got a bunch of Americans on this call, and it's just a nice tongue-in-cheek way on a Friday to talk about currencies. But it is actually a pretty good representation of what the PPI, the Purchasing Power Index of currencies, ends up being. The Economist magazine put out the Big Mac Index back in the 1970s, and all they just identified was how much a Big Mac would cost you in each given country. What you'll find is that right now, there's only a few countries that are actually more expensive than the United States. So those are the ones to the left: Switzerland, Norway, and Sweden. Actually, the new publication came out this week, and we didn't update this slide, so I apologize for that. But essentially, Sweden has fallen out from the top, so it's just Switzerland and Norway. That means the US dollar is extremely expensive compared to global currencies. And when we take a longer term trajectory, essentially every 10 to 15 years, the dollar goes from being at strength to being at weakness. So we've spent 14 years where the dollar has been strengthening. That's not me saying the time is ticking. It's just to say, if the dollar falls, it has room to fall in big ways because global currencies could go on a long-term growth rate. I tend to think that right now, the Federal Reserve is moving first at increasing interest rates. So we will have some more dollar strength, i.e. people buying into the US dollar for the higher interest rates in the near term, pushing up the dollar. But when all of the other central banks start catching up to the US, essentially that might swing in the other direction. So the question will be, who has the most inflation and who's able to control it first? And that's to where the next couple of years could be big movers for a lot of currencies. The total right side of that list, including China, Poland, Turkey, South Africa, and Russia, all of our emerging market countries. Now, emerging markets, even though the S&P 500 did wonderfully last year, emerging markets did horribly. And a big reason is because of the currencies. When the dollar goes up, emerging markets typically go down because most emerging markets' debt is in dollars. So servicing that debt costs them more. That means when the dollar tops out and the dollar starts going down, essentially emerging markets could be the best performers inside of a portfolio. But it's to say, these are all moving factors. And the easiest way to control our risk is if we're living and buying our bread in a currency, if we're investing in that currency, we've minimized that currency risk. So if you live here in the UK, we might decide to have a bigger portion of pounds. Same thing over in Europe. Now, if we just go back the last 10 years, we had 7 strong currencies: Australia, Canada, US, UK, Switzerland, Norway, and Sweden. It doesn't take much of thinking about the past to think where we had a commodity shock. The Canadian loonie and the Australian dollar are very linked to commodities, and so therefore they dropped in value, and we're no longer part of that strong currency mix. Now, all of a sudden, with Brexit, the UK fell out of that strong currency mix. So that's to where most of those flows went to the US dollar instead of, in the pandemic, in a flight to safety. Historically, we have a flight to safety, and then as the overall global economy recovers, that money comes out of the safety and goes out to the other marketplaces. So there's more move for it to go down than up in the longer term as we get to recovery. So we build all of our different lines into 3 different currency rates. We've got euros, US dollars, and GBP. Now, if you look at that burgundy portion, essentially, you'll notice how much of our portfolio is in US dollars. And so therefore, on the US dollar portfolios, the MSCI Global states that about 57% of the world is in US dollars. So we're going to have around 57% or more. We've had it up to 60 or 70% at times, but essentially we're not going to go much below 57%, even if we become bearish on the US dollar. But you'll notice that it's much smaller in the GBP and the Euro portfolios because we want to increase the amount of exposure that we have in pounds in our GBP portfolios and euros in our Euro portfolios. This, again, becomes that natural currency hedge. We're owning more of our own currency, and therefore we're going to have less volatility over the long haul because we own in what we're buying our bread. All of our GBP portfolios mean that we're buying only US regulated securities. They're all MiFID compliant, despite the news from the Johnson administration here that they're going to start changing their linkage of the financial markets with Europe. Very interesting stories because that could lead to a lot of deregulation, but the UK is still subject to MiFID rules right now. Just means that you don't want to buy US mutual funds either. There's zero punishment for owning US mutual funds, but when the US is fining or taxing excessively Americans abroad or individuals that have American linkage for owning non-American funds, it's not far-fetched to imagine that Europe and the United Kingdom might do the same. The United Kingdom already is, but on the HMRC list. So if you live here in the UK, you'll want to be very vigilant of the HMRC list. This is a list that basically anything in the UK, still anything in Europe, and about 90 exchange traded funds in the United States are on this list, and therefore they're only taxed at 20% instead of your regular tax rate. This can be a huge saver for you if you have your portfolio over here in the UK. If you have an old US portfolio and it's filled with mutual funds and the likes, you probably want to review it and see how you can minimize those risks, or figure out if you can get on the remittance basis here in the UK to reduce those. Any of our portfolios are going to automatically only hold ETFs that are HMRC compliant. The Euro portfolios, we won't own any mutual funds in them because they're not MiFID compliant. Again, zero punishment, so I'm not trying to fearmonger you into that, but there's a reason that most mutual funds do not allow you to purchase them in Europe, and that's because it just doesn't meet those European guidelines. So that's the difference between the different currency lines of those portfolios and why we actually just try to reduce our risk by doing so. Now, Dunhill Financial is a financial planning firm. We help individuals with their full retirement plan, their estate plan. We help them put together their cash flows and put together all of their investments. But we know that everybody is not in that position that they can afford or that they have the minimums to actually get started with a financial advisor. So we introduced two programs that we can help emerging affluent or those that don't need a full financial plan. Maybe you've already got your financial plan taken care of and you just need a means to be able to put away a monthly amount or a lump sum amount. So the first thing that I'm going to talk to you about is DF Direct. It's its own separate website and separate company from Dunhill Financial, but it gives you the opportunity as American expats to go ahead and invest on the American markets. Right now, if you go to DF Direct, if you have a US address, you can set it up directly online. You can get it approved right away. If you don't have a US address, don't worry. It's just a little bit more manual process. So we can still set you up no matter what country you're in, apart from Canada. I'm sorry, there's different regulations there, and Japan. Those are two countries that we can't deal in, but we can introduce you to some of our friends over there that understand those markets very well. So every single one of you can actually set up an account with DF Direct. There's zero minimum, and the annual charge for those accounts is 0.5% with no exit penalty. So if you want to invest for a few years or all the way until retirement, you can get on there and set it up. Again, if you have a US address, you can go on there, you can set it up automatically, no problem. If you don't have a US address, You'll just go through those steps, and instead of setting up the account directly, one of our associates will be in contact with you to manually do the paperwork and get you set up. So why do you want to use DF Direct? Well, first of all, they're all US compliant investments. You won't end up with any PFIX or any other problems like that. There's a low cost. It's a little bit more expensive than a Betterment or a Nutmeg, but essentially that's just because of the cross-border issues that we have to deal with and pay for. But basically you can start at zero. You can send in any amount you want. And essentially it's an online experience. You're going to be able to essentially set that up and have those access points to all of our tools right there in the United States. So at this point in time, what I wanted to do was, instead of just going on and on about all the things that I thought were interesting to cover, I thought it would be more fun to jump into the Q&A and answer any questions that you have, which I'll start jumping in there and talking to those. So please add your questions to the Q&A. Michael's going to join us and help us go through these. Do you want to ask the questions and I answer them, or do we want to just dig through, Michael?
Do you want to go? You're looking at them as well, Brian. Do you want to pick out the ones that you think would be most useful, and I'll keep an eye on new ones coming in.
Brilliant. Robert points out a perfect question. We covered this a little bit about mutual funds in Europe. Essentially, those US mutual funds, there still are some that will accept you as clients. There's absolutely no problems with owning them. So that's why I've leaned towards only owning exchange traded funds. I never buy exchange traded notes, and that's just because the risk behind them. An exchange traded note is on the investment bank's balance sheet, whereas the exchange traded fund has its own balance sheet. In other words, an exchange traded note can technically go bankrupt without the parent company going bankrupt. And that adds an extra layer of risk. That to me is just trying to be as conservative as possible with investments. Buying a foreign ETF is still classified as a PFIX, so beware of those. But I would stay away from US mutual funds at this point in time. The good news is most of the big houses, even American funds, which is one of the biggest mutual funds in the United States, I think they're number 2, they have started actually putting out their products as ETFs. PIMCO, which is the biggest bond manager, has an ETF. Vanguard, as you know, have plenty of ETFs, and some of them are even HMRC qualified. So it's not that you have a lack of products to utilize just because you can't access mutual funds. What are good services to use to invest in stocks as an expat? So essentially, as I said, DF Direct is our service that you can utilize at any time. It depends on what countries you're in. So basically, most of the big institutional firms will deal with most countries except for Italy and France seem to be on their list that they don't like. These are your Fidelities, especially, will allow you to open an account abroad. Charles Schwab as well. We have chosen to work a lot with a group called Trade PMR, just because the service is wonderful. But if you're wanting to buy and sell individual stocks and you don't mind a digital experience, a lot of people have had success with interactive brokers, depending on what countries they're in. Let's see. U.S. financial institutions are avoiding residents in France like the plague. Do you know of any U.S. institutions which is offering Roth IRAs for European-based Americans? Yes, France is always one of the complicated countries out there. We are working with some vendors to basically build out DF Direct so that you'll be able to automate the process of setting up the Roth IRA right there. Right now, essentially, interactive brokers will allow us to open a Roth IRA, but they'll only allow, their interpretation of MiFID is a little bit harder, which is only allowing you to buy individual stocks instead of even ETFs. So that becomes a little bit more problematic. When it comes to things outside of the IRAs, it's a little bit easier, but France is one of those problematic countries. living in the EU, is there any way to invest in euros and avoid PFICs? Are we limited to just transferring money to the US for investing in individual stocks and bonds? That's a great question. And the answer is yes. We have a service through Premium. Premium is an Australian company that has a big office right down here in London, actually. And they're getting bought out by Morningstar. So everybody knows Morningstar, the ratings agency. And they allow us to have US investments. You're able to get your 1099, but you can set up a euro-based account. So all your cash is in euros, and it's held outside of the United States. The disadvantage of that is that you do have to fill out an FBAR because the account is held outside of the United States, but you do have a euro-based account. So we do have that solution for you, for anybody that wants. Do we have any financial institutions offering viable investing solution for American residents in France? We already covered that. Well, what if your spouse, a non-US citizen, has an ISA? Do we have to report it? So the questions here in the UK, they have ISAs. These are individual savings accounts. And essentially you're allowed to put £20,000 a year and it grows tax-free. Now for Americans, it's a little problematic because you can't own UK collectives, otherwise it's a PFIC in the United States, and the UK won't allow you to buy foreign ETFs in there. So we're only able to buy individual stocks. So you can only either have a cash ISA or only individual stocks. We have a line for Americans that works perfectly, but it's only for the growth-oriented and aggressive growth-oriented clients. Now, with a spouse, it depends if you're reporting as married filing separately or married filing jointly, which essentially becomes that tax question. If you're filing separately, then you're not reporting any of their investments and therefore they're non-US associated. So I would double check that with your tax accountant, but as long as you're not filing them on your tax return, you're totally fine. If I keep my assets in the US, as you recommend, but plan to continue to work, live, and retire abroad in Germany, does this still make sense? So Gwen, yes, we have plenty of clients that do that, and plenty of clients in Germany. Actually, our compliance managers over in Germany, and so that's where we know the market very well. By keeping the money in the US, basically we're just avoiding those PFIC issues over there. Getting the money over to Germany is a one-step process and very, very easy. Later on, it might be better to move it to a platform like Premium if you feel more comfortable with getting the euro-driven statements. If you're worried about exchange rate risk, wouldn't it make sense to hold, for example, UK stocks in your US portfolio? Yes, that's predominantly what we did, what we do with those GBP portfolios. We end up owning more of the UK stocks in there to minimize that risk. Do you need to file an FBAR if you have a mortgage with a UK bank if the sum is over 10,000? Now that's more of a tax question. I don't believe you need to, but I'm not the tax expert. I've never seen anybody do so. So I doubt it, but don't take my word for it. Is your Euro portfolio not a PFIC? No, it is not a PFIC. All the securities inside of it are US ETFs, exchange traded funds. So therefore it's not classified as a PFIC in any way, shape, or form. Does a foreign pension trigger Fatca if foreign cash and pension is over 200K? So again, that is a little bit more of a tax question from the vantage point of how to file it on there. Now, I've heard mixed answers, but again, I am not the person to ask because I am not a tax accountant. I've seen most people not classify it on those because it's hard to get the triggered valuation on there. I've seen other accountants actually represent it on there. I think it's a question for your accountant of what they feel most comfortable with. It's always going to be more conservative to disclose it on those forms because, well, I'd rather be overly conservative rather than overly aggressive. But then again, I don't have to do the work. Okay, so a great question here from Leonardo. How does DF Direct differ from, say, interactive brokers like? Extremely simple. We build you a portfolio, and we make sure that we rebalance that portfolio and keep that portfolio invested. We're making sure that it conforms with all of the local rules, the UK or Europe, or if you're going to go back to the US, that it's in line with a US dollar portfolio. So in other words, we're designing a portfolio and making sure that it's implemented for you, similar to the large robo advisors like Betterment in the United States or Nutmeg here in the UK. Michael asks, since he's in Japan, can he use DF Direct? At this point in time, we don't have the ability to do work in Japan. So if you have a US address that you're able to use, we would be able to help you, but we can't use a Japanese address. And it's not because we can't read it, it's just because the regulators won't let us. It says DF Direct is currently available for people with a US address. What about US citizens in the UK with no US address? Just if you go on there, either just drop myself an email or info@Dunhill Financial, and we'll set you up manually. So anybody that doesn't have a US address, no problems. We just have to set you up manually still. We should be, hopefully soon we'll be able to do that straight through the website, but it's a large build out. How would we get recommendations from Americans in Canada investing? Also, any advice for required minimum withdrawals from TIAA? So Susan, great question. So in Canada, if you put in Google American Expat Financial Advisors, there's several of them. I know 4 or 5 firms. If you can't find them, just drop me an email and I'd be more than happy to help you out in getting you some names over there. They're really quite good at what they do, because Canada is a little bit different from most other jurisdictions. When it comes to required minimum distributions from TIAA, it's a little bit different because it is an annuitized version on that. And so it depends how the HR department has set it up for you on how many years is the minimum or the maximum. And this is something that you'll want to think about from a currency vantage point, because if you have an annuity, let's say it's a 10-year annuity for the TIAA portion. Now that annuity is going to be coming out in dollars, but you might be living, or you're living on Canadian dollars. So what I would advise is putting together that action plan to try to mitigate some of that currency risk. A lot of our clients will actually take out and roll over more of their TIAA early so that they don't have as much currency risk, i.e. they roll that other portion into an IRA that they go ahead and naturally hedge into their currency to minimize that currency risk over the course of that period of time. David says he moved to the UK 2 years ago and is trying to figure out where to start for investing in the UK. Where would you advise someone in their early 30s to start? Well, David, I think we've got that right on the screen. DF Direct would naturally be the place that we would get started, just because it is nice and low cost and you don't have to worry about those minimums. Leonardo's asking about Italy. Italy is just like France, that essentially we're either using an international provider or a US address. We're hoping to be able to roll out more providers in the future, but Italy and France are both harder countries in Europe. The rest of Europe is much easier to set up accounts using that foreign address. Let's see. Can an IRA distribution be taken without US withholdings and simply declared as income on a Canadian tax return? So most all of the providers have now actually increased their withholding tax and require that withholding. That is more of a directive from what I understand. Again, disclaimer, I'm not the tax guy. From what I understand, that's a directive from the IRS that they're trying to get more withholdings, and then the applications for the money to be returned done after the fact. So Robert, if you're essentially having a withholding tax, that is probably the opportunity to go ahead and file that. Make sure you file that U.S. tax return, because you can get the money back if it wasn't owed in the United States. And otherwise, you probably will get a deduction on the other side, according to the double taxation agreement. Steve says, my understanding from the presentation is that mutual funds in a retirement account is no problem if living in most other countries. But what about the minimum required distributions I receive from these mutual funds wrapped in my retirement account? Are these taxed by the EU if I'm an expat living in that area? So Steve, so first of all, it's not a distribution from the mutual fund, it's a distribution from the IRA. And it's a little bit different for each and every country. So it's not an EU-wide rule. Each country has a double taxation agreement, and you can find these directly on the IRS website. Even better, most of them have a short summary on there. But for instance, France, you're only taxed in the United States on those IRAs, so you don't have to worry about any French tax. It's only US tax. But Germany and Spain, they're quite aggressive of charging that tax on the distributions as earned income. So it depends which country you are, and depends how the double taxation agreement works. It's not a European-wide thing. Can you speak to strategies for long-term US expats in the UK or planning for a big 7-year status when they will presumably switch from remittance and a rising basis UK taxation? Rebalance current ETF portfolio with only UK reporting fund status? Yes, this is a wonderful question. So the remittance basis is basically a rule here in the UK that says we can go ahead and anything outside of the UK not be taxed in the UK. It only lasts for a period of time, so you want to make sure you clean up anything if you're going to stay here past that remittance basis point. So definitely cleaning that up, and maybe if it's a large enough portfolio, you don't want to do that all in one fell swoop, because then your US tax bill will go up. But essentially, cleaning that up piece by piece and optimizing it over the course of time that you have from now to the day that you're off the remittance basis is going to be the best way that you can make sure that you don't end up having large tax bills here in the UK when you're no longer on that. Can I open a DF account if I'm technically a US resident but spend most of my time abroad? Absolutely. Your residence in the United States doesn't necessarily have to be where you're spending all your time. It just has to be a place that is considered a legal address for you. So no problems there. And if you have any questions about that, please just drop me an email after this presentation, and we'll get you all sorted out. Let's see, it seems I should. So here's an anonymous question. Is a PO box sufficient for an address, or can I use a family or friend to link through? I'm selling a house. So this is always an interesting question, and it depends from broker to broker. Most brokers will not allow us to set up accounts on PO boxes because, like I said, it's not a legal address. And sometimes if you use a friend or family's address, there are some drawbacks to some of those, which essentially a lot of times they'll ping them back as not recognizing you from being at that address. So they'll ask for a utility bill or the such. These are things that are kind of personalized. So if you contact us, we'd be more than happy to help you navigate that solution. But a lot of times the PO box doesn't suffice to meet their needs. Do you offer special solutions for someone who is a dual citizen, European and USA, living in the UK? That is my exact situation. So yes, basically I can copy my financial plan and give it to you. Having multiple citizenships basically doesn't change anything. You're still American at the end of the day in the IRS's view, and where you're resident is where you're taxed over here. So if you're a European living in the UK, basically we really have to only worry about the UK for right now, the US for right now, and the European aspect comes into place if you're going to plan to move back there, that we might build you a European portfolio that's HMRC compliant, so that we're hedging for where we're going to need the money, not where you are currently. So that's the only time that third citizenship is applied.
Brian, can I throw in a couple as well? There's
Absolutely, please.
a couple of specific questions about your DF Direct.
Absolutely.
Michelle says, how could a young person with a very small amount start out with DF Direct? What would be a simple start for them?
Absolutely. Setting up the account has no cost. And at that point in time, you can send in as little as $50 a month. You can actually send, if you're setting it up on the US address, you're able to send in pounds or euros. There's no required minimum amount, and there's no set amounts. So you could send it off as a one-off and then wait 6 months and send another one off. So you set the parameters of how much you want to send in.
Excellent. And another one on the same subject. You mentioned a Robo Advisory. Is that DF Direct?
That is DF Direct. So right now, with those foreign addresses, it's not so robo, it's quite manual, but it is slowly getting to that full robo solution, like what you would see from a Nutmeg or a Betterment. It's essentially going to be fully digital.
Okay, and do you have experience of Switzerland particularly? Because you may have just seen this one popping up. In Switzerland, I was told that you're taxed yearly on worldwide wealth. Would my US-based brokerage accounts be taxed? What type of investments would you recommend bearing this in mind?
Yeah, Switzerland is one of those jurisdictions that has some complexities. Essentially, there's two issues that I normally jump out. And yes, the US account would be taxed on the Swiss side, just as if it was in Switzerland. The main reason we still prefer it in the US versus Switzerland is because it's much cheaper to run it, but the taxes in Switzerland would be the exact same. The other thing in Switzerland that you want to be aware of is how the taxation will work on your pension. And this is very similar in most countries except for Canada and the United Kingdom. When you put money into their pension system, Switzerland typically, when you leave Switzerland, will ask you to take the money out, and therefore you're going to get this lump sum distribution. The US will consider that a distribution that should be taxed, and it might be a larger amount. If you're using the FEI system, the foreign earned income exclusion, that basically means that's all taxable income. If you were using the credit system, you might have some leftover credits because they can be carried forward up to 10 years. And therefore, even though it's all taxable in that year, you might have enough credits to cover a big portion of that tax bill. So it's something to be mindful of your exit from Switzerland, because those pension systems don't really talk very well in the double taxation treaty.
Great. Actually, we've got a nice comment from somebody who says it's a great presentation, lovely, but asking if they can have your email, please, because you're saying people should email you. They're here as an EU citizen, not as an American. I'm sure you can look after them as well, though.
Absolutely, absolutely. So my email address is just brian@dunhillfinancial.com. What I'll do is I'm going to just put that in the chat so that you guys all have it right there. And if you don't remember that, you can always just go to our website, and if you send it to info@dunhillfinancial.com, it will come to me. It will just come into a separate box. So
excellent. Actually, while we're at it, I might as well just mention the American Magazine's website, which is www.theamerican.co.uk, because we actually have a lot of articles from Brian and experts like him, which can help you on these matters as well. And there's a free newsletter that goes with that. So just go to the website. You can sign up there as well. Thanks for that opportunity to do that, Brian.
It's a wonderful magazine. We always dig through the newsletter and see all the things that we've missed back in the States or that are going on globally.
It is a mixture of things for Americans abroad plus American sports we're big on, actually. We do a lot on that as well. Good question from Robert. My US address is a full service mail service. Would it be considered differently than a PO box?
It depends on the custodian. And so the short answer in a public forum like this is no, it doesn't meet the criteria because it's not a mailing or legal address. If you emailed me and asked me in a different way, you might get a different answer. If that makes sense.
I'm sure it will. All right, I think we've actually covered most of the major topics that have been coming up. Actually, there's a specific question from Leonardo, who you were talking to earlier on. You said everything is online. Do your services include contact with a customer service advisor? Is there a team of people we can talk or even meet with? How does a potential customer gauge how safe it is to invest with you? Well, yeah, that's a very good question. I'm sure you can address that.
That is a beautiful question. Thank you. I didn't even get into that. So there's two sides of the business, like I was saying. There's our financial planning side, and then there's the asset management. The asset management being DF Direct, and the financial planning business is Dunhill Financial. Now, one of the nicest things about how we've set up this structure is that essentially you can move your account from one service to the other service as much or as little as you want without any cost. So let's just say you come in, you have a complex situation, and you want to do a full financial plan. We build the financial plan. A year from now, you decide, all I need to do is send in X amount per month and I'll be able to achieve my financial plan. We can actually move it over to the Robo Advisor so that your fees are significantly less and it's going to be less costly. Now, to get back roundabout to your actual question, yes, we have a full team of financial planners and associates that can help you from everything from the administration, compliance, trading, and financial planning. And either way that you're going, you're able to contact that team and set up the structures. So you don't have to decide which service you want from the get-go. You basically have the conversations with us, and then you decide which direction you'd like to go.
For that, Brian. Australia has an interesting question. Are you familiar with Australian superannuation? Not taxed in Australia when you retire, but not sure if it's taxed by the IRS. Can you address that? Yeah.
We know Australia well. We did several presentations with American citizens abroad over in Australia, in Sydney and Melbourne, and dealing with the double taxation agreement with Australia. You'll find a lot of advocates trying to get them to fix it. Superannuations are not recognized by the US government, and IRAs are not recognized by the Australian government. So this means you need to do plenty of planning when it comes to how you're going to structure those pieces and how you're going to deal with those distributions and try to minimize and offset as much tax as possible. So they don't talk very well with each other. Most of the double taxation agreements are problematic in those types of ways. So using foreign pensions, which a super is a mandatory foreign pension, can become problematic in setting up that structure.
Fantastic, Brian. I think we had, like I was saying earlier on, and then we found some more. But I think you have covered some fantastic issues there. From the comments that are coming in, you've done an amazing job, and it's been an interesting discussion and answered a lot of points. I think we'll wrap it up there. We're just on the hour, and say thank you, Brian, to you, of course. Thank you to everybody who's attended. Thank you for the great questions. That always makes things go with a swing as well. We'll be doing, you mentioned American Citizens Abroad. We've actually got a presentation from them next, which will be at 11 a.m. EST, 4 p.m. GMT, about their advocating activities and what they're up to. And then we're talking about crypto after that. So please stay with us for the next two sessions. But for now, Brian, thank you so much for a fascinating discussion, covered many issues that have been of great interest to people and of great help as well. So thank you, Brian, and goodbye, everybody, for now.
Thanks so much, Michael. Thank you, everyone. Have a wonderful weekend.
Bye-bye.